Welcome to the True Commercial Real Estate Podcast, your ultimate investor resource for all things truly commercial. Whether you're interested in industrial, retail, medical office, storage, single tenant, or any other type of non-residential real estate investment, this is your podcast. Everybody, thank you for joining the True Commercial Real Estate Podcast. Our guest tonight is Bridger Pennington. He's the founder of Blackbridge Capital, privately run debt fund that has now done over 290 deals in 38 states over the last 2 years. On the side, he runs investment fund secrets to help others start their own funds in a world where people believe you need an Ivy League credentials or Wall Street experience to break into. He's got 25,000 YouTube subscribers, has over 140 videos on his channel. Please welcome fund manager, investor, coach, YouTube rock star, and father-to-be, Bridger Pennington. Did I miss anything there?
Yeah, man, that was probably the best introduction I've ever had in my life. That was great. Good work. No, excited to be on. Thank you guys.
Yeah, this is great. We're super stoked. So we've got a bunch of real estate investors that participate here and who check into our channel, Facebook group, and I think every one of them is going to learn something tonight. We're really psyched to have you on. So welcome. Just to get started and just to kind of jump into this thing, can you give us a bit of your background and tell us what you're doing and you know who you are?
Yeah. Bridger Pennington, thanks for having me on, you guys. I'm excited to be on the show and chat funds, and we can dive into all sorts of stuff on this call. But I started my first fund at 22 years old. We can dive into that story if you'd like. Our first group of investors got a 64% return. We launched our second fund that did really well. And I actually, that you just put it on there, but I just sold that fund about 2 months ago to one of our competitors, just bought us out. And now launching a third fund, we've soft raised about 18 million for that fund and looking to raise 50 million. It was pretty fun. And then we've started investment fund secrets. Like you said, we have about 4,000 students that we help launch and scale funds, which is really fun to get into and do. And we've had one fund, they've raised $700 million in the last 14 months, $2.5 billion AUM, two funds that are approaching 100 million. We've got a couple funds around 50 million, then a dozen or so above 10 million each. So it's pretty cool to be around people that are launching and scaling funds. And, I guess that's the long and short of it. My dad, the reason I got into this, we can talk about that story as well, but my dad runs a $10 billion fund. They're just over $26 billion. He's the co-founder of that fund. Grew up in ghetto North Las Vegas, graduated C's and B's. Myself, none of us went to Ivy League schools. My brother is a securities attorney, and we all just kind of found this fun game unconventionally and have done it. And that's why we started Investment Fund Secrets, just because regular people like me and you can go out and start funds. It's not reserved for the Ivy League grads or the people that are in the Vanderbilt family or whatever. Regular people can go out and do this. And there's actually a lot of people scaling and launching funds. And it's one of the most lucrative vehicles on the planet to make money. It's incredible. The amount of wealth that's generated in funds that most of the world does not know about. So anyways, that's what we're trying to do. That's what we're trying to break into and help more and more people understand. So that's the long and the short of the intro. There you go.
That's awesome. Awesome. So you had mentioned getting started in the beginning and launching your first fund. And I think most people here are probably going to relate to that story more than anything. You know, you're a good many steps ahead of most of us, but a lot of people here and a lot of people who are going to be listening are going to want to start their first fund. Can you talk to us about that and the story behind that?
Yeah, I grew up in an entrepreneurial household. I was a nice house. My dad drove a crappy car. We had food on the table though. It was a great place. And I did not know my dad was running this big fund. I mentioned that earlier. I didn't know that. I just went to high school. I went to college. I got into college, very ambitious. I started 6 businesses my first years of college, and not business ideas. These were businesses that were up, like actually making money. Pretty much any business on YouTube that was like make money. I tried it. We did Forex trading. I tried building websites. I wholesaled 2 houses. I mean, we did I had Chinese tutoring business. I mean, we did all the above. And finally my dad grabs me, goes, Bridger, you're kind of like a chicken with your head cut off. I want you to go meet with one of my business partners. And I said, okay, I'll go meet with whoever. That's fine. And so we set up this meeting, and I remember I got in the car. I started to drive to this guy's house, and I pulled up into this really nice area, gated community. I pull in through, I'm looking on my Google Maps, and I pull up this hill onto this beautiful home. It's almost encompasses this cul-de-sac, has a great view. And I kind of double check my phone. I'm like, who's my dad's business partner? This guy's, what's going on here? And I get out of my car. I go knock on the guy's door, and I'm a little nervous. It's just this wealthy guy's house. I knock, and I'm worried Butler's going to come and kick me off the property or something. But anyways, long story short, my dad's business partner answers the door. He goes, Bridger, come on in. He welcomes me and we sit down on the couch as we start to chat. And we start chatting about life and business and college and careers and all this kind of stuff. And he goes, and finally I ask him, how did you get all of this? How did you do this? And he goes, honestly, when I was in my 20s, I was a lot like you. I had started multiple businesses. I actually had decent success. I did really well. But then he goes, then I figured out the secrets of the ultra wealthy. This is what the ultra wealthy families of the world do. They have their kids and they will try to get them into the best colleges, and they'll even cheat to get them into the colleges. We've seen that happen in the news, right? And they hope they go work in investment banking or consulting. And then they hope they go on to hedge funds or private equity funds and scale those up, or come back home and run the family office. I mean, you see a lot of families do this, and a lot of wealth created around the fund model, whether it's private equity, hedge funds, real estate funds, debt funds. You see a lot of money created around this. And so he said, I met a gentleman who was doing this. And I said, I don't care how long it takes me. I don't care if it takes me 1 year, 5 years, or 20 years. I was going to figure out what a fund was, how to build one, how to scale one, how to start one. Because even if I'm decent at running a fund, I'll make way more money than if I did something else. And so anyways, I was just intrigued. I wanted to learn more about this fund world. And so I've always heard from guys like you on podcasts. I always heard, find a mentor. And so I thought, well, this guy should be my mentor. I'm going to ask him. So I said, hey, I would love to learn about funds. And oh, by the way, he goes, and this is how I built this whole thing. He goes, at the time we manage an $8 billion real estate fund, doing primarily multifamily real estate. To put that in perspective, Cardone Capital, Grant Cardone, they manage just over $2 billion right now. At the time, they were 4 times bigger than Cardone Capital. Today, they're over 26 billion. They're 12, 13 times larger than Cardone Capital today. It's just incredible. And they're buying in the same spaces and all this kind of stuff. It's really incredible what they've done. And I was intrigued. I asked him to be my mentor. I said, hey, can you teach me, right? And he goes, Bridger, go talk to your dad. Your dad knows way more about this than I do. And I said, no. My dad's poor. He drives a car with 300,000 miles on it. I want to learn from you. I want to learn from you, obviously. And he goes, Bridger, sorry to break it to you, but me and your dad make about the same amount of money. And my chin about dropped to the floor. I was like, huh? Come again? He's like, yeah, I mean, we're pretty much equal business partners. And I left this guy's house. I drove straight to my dad's house. I was like, Dad, what the heck? What's going on? Why have I not been able to, order a soda at Chili's or wherever we go to dinner because it's too expensive. And yet you're running this multi-billion-dollar fund. And anyways, sorry, I'm going too long and feel free to interrupt me.
You're good. It's fantastic.
He goes, yeah, we run this fund. And anyways, long story short, my dad started to teach me about funds, what funds are, how they run, how they work, all that kind of stuff around funds. And over the next 8 to 12 months, he started to teach me about this. And what happens when you learn something is you start to look for that thing, right? Tony Robbins talks about that little thing in your brain, right? If you see someone driving an Audi, or if you're going to buy an Audi car, you start to see Audis everywhere. And the same thing happened for me with funds. So I started to learn about funds, number one. And then I started to see opportunities that I could use a fund. And I was working actually at another company at the time. I'm in college working at a company as well. And I had this great idea. I was at this company. I was like, oh my gosh, we could fund clients that are coming through this business. I talked to the owners of the business. They thought it was a great idea. I talked to my dad. He thought it was a great idea. We put together this whole fund and project. And we were ready to launch. And I'm 22 years old and I was so excited. And I'm like, shoot, I kind of overlooked, for whatever reason, one of the biggest things in a fund is the money, is investors, right? That's the purpose of a fund is, and I just, for whatever reason, didn't really think about that much. And I thought, well, my dad is rich. He would love to invest in this fund. And I'll just ask him. And so I remember it was a late Sunday night. I went and knocked on my dad's door, his little home office. And I remember walking in his office and I sat down in my best pitch voice possible. I said, Dad, how would you like to be our first investor into our fund? And just like that, with my hand and everything. Yeah. And he kind of laughs and he goes, Bridger, I have the money to invest, but if I invest in your fund, it would ruin the experience of you raising money on your own. This is a crutch that you'll never be able to recover from. Your first investor is your hardest investor to find. And he said, no. And it was a big, tough love moment between me and my dad. and he kicked me out. He said, go figure this out on your own. And I took him up on the challenge. I went out, I hit the streets. I talked to everybody I knew that had money, and I raised a whopping $49,000 for my first little micro fund. And it was teeny small, but I was stoked. I was so excited, and it was enough to get started. We were doing these micro loans. They were like $1,000 to $5,000 a loan. We launched this little fund, and our first group of investors, we got them a 64% return. It was awesome. We sent the money back to them. We restructured and actually filed, like, we kind of rebuilt the fund, made it more established. And then we launched a second fund there. That fund did really well. We raised and deployed millions of dollars out of that fund, did extremely well. And I just mentioned at the beginning, we just sold that fund about almost 3 months ago at this point. And right now trying to transition to a third fund. And it's been just an incredible journey. So I'm in the game right now. I'm in the game of funds and on this right now, but that's kind of how I got started.
That's awesome, man. That's fantastic. I love that story. I love that. My dad certainly doesn't run a fund, but he definitely is the type of person who you would have zero idea how much money he has, because he is like, it's like he's retired now, and he's plenty of money to do whatever he wants to do. And it's the same thing. It's like, well, I think I'm going to get the chicken instead of the fish. The fish is $2 more. And I'm like, Dad, what the hell?
What's going on?
Come on, bro.
Well, and by the way, just my dad still this day has never invested in any deal, project, property, anything I pitch him all the time. I literally pitch him all, and he's a very frugal guy as well. Awesome. And kind of lives the millionaire next door lifestyle. If you ever read that book. So anyways, kudos to our pops. There you go.
Very cool. Very cool, man. That's awesome. That's awesome. So I think most people on this podcast and most people listening are probably somewhat familiar with the syndication model of raising. So can you dive into a little bit of what a fund looks like and how it differs from a syndication?
Yeah, great question. Everyone on this call, you guys all know how syndications work. For people that don't, I'll just run through it briefly. But typically, and we'll use a house flip as an example. A lot of times a house flipper will find a house. They go, they like the idea of it. They got to go raise money now. So they use either their own money, they use hard money loans, or they use private investors / they can use a bank too. If they have a line of credit, they can pull as well. But usually those three, or four, they've got to group the money together. They've got to convince an investor, put some money in. They set up some kind of LLC or some kind of structure. They put the money in there. They acquire the property. They fix it up. They rehab it. They sell it. They liquidate their investors, and then they restart. And they got to find another property. They got to re-pitch those investors. And a lot of times on the investor side, investors want to renegotiate. Hard money lenders, they got to relook at the deal. And it takes a lot of time. And you guys, as you guys know, it takes a little bit of time to set, and then you got to set up new entities and all that kind of stuff. And it's a great way to get started, a great way to build a track record. Unfortunately, it's very hard to scale. And some people on this call, I'm sure you guys have actually gotten really good at scaling it, where you get investors that are ready to go, and you kind of train your money to get to the deal fast. But oftentimes you'll still have problems. Actually, an example, one of my dad's first funds, $70 million hard money lending fund. Excuse me. That was their fund. This is before their fund. They were doing syndication. So they're doing hard money syndications, anywhere from $500,000 to like $6 million syndications. They had a deal. It was a Friday closing. All the money was getting wired in, all the investors. They had it was like a $2.5 million deal. One investor didn't wire in the last $120,000 just about. His bonds didn't clear, whatever it was. And they missed the deal on a Friday closing, lost their earnest money, all this stuff, and lost their confidence from their investors and other people bringing them deals. And that was the biggest thing, was the reputation. It tainted them, and they didn't do anything wrong. It was another investor, and they said, enough. And that's why most people that are successful in this game of, whether it's and for your show, real estate, or raising capital and buying assets or property, eventually end up in a fund. Because what a fund allows you to do is you set up your entities once. You set up your fund structure once. You raise capital once. And then if you have a deal come across your desk, you already have the pool of money. Either you issue a capital call, or you've already got the money there, and you can transact. It's funny. I was actually talking to another fund manager, multi-billion-dollar fund manager. He goes, and they're bidding on real estate, multifamily properties over 200, 250 units. And he said, we actually, a lot of times we're not the highest bid, yet we win these contracts because we can transact. We have proof of funds. We can close faster than other people. And so sometimes we come in 4% or 5% lower than the highest bid, yet we will win the contract because of our reputation and that we can transact and close. And they know we're a credible institution that'll close. Another example, we had a guy in our group last year flipped 4 houses. And I know you guys don't do residential, you guys do other stuff, but he's a house flipper, flipped 4 houses. He started a fund end of last year. And this year he's flipping 72 homes out of that fund.
Wow.
Okay, a fund allows you to scale, right? That's all it is. It just bolts on to whatever you're doing. And it's a vehicle that allows you to scale well beyond what you're doing now. And now 72 homes, he's got teams that go out, he's got crews, he's got all sorts of stuff. And next year he was telling me he wants to do over 100 homes next year as well. So it's pretty cool to see what can happen inside of a fund. The last thing I'll share, and I know I'm rambling on, feel free to interrupt me.
You're good.
The last thing is the legal protection. In a syndication, if one of your investors gets mad at you, doesn't like you, has a tax liability, they have a little bit of clout over the deal, right? Because sometimes they're signers, they're on the property, they're on the deed, however you set it up, and they can come in and really move some things around, and they can sue other partners. I mean, there's a lot of things that can go on inside of a fund. You have so much protection from investors. You could have, this is the reason 4 guys and gals on Wall Street can manage billions of dollars. And one of their biggest investors comes to him and says, $100 million investor. Hey, Bridger, I've got this big tax bill I've got to pay. Can you guys sell some of the properties and get me out a little bit early? Cause I got to pay this thing. And you go, no, sorry. My fiduciary responsibility is not to individual investors. It's to the fund in general. These properties are not ready to sell. I'm very sorry, but when you put your money in, this is what you signed up for, and the properties are not ready to sell. And really, unless you commit fraud or something, there's no legal action that person can take against you. It allows so much control and protection over what you're doing, and actually offers the other investors protection as well. Because if you're going to invest in a deal, you hope that the other investors don't sue you and come after you. Inside of a fund, it gives you all that protection. So if that made any sense, I rambled on a little bit, but hopefully that made a little bit of sense.
No, that's great. No, that absolutely makes sense. There's a ton of advantages there you mentioned. That was my next question, and you pretty much answered it. What are the major advantages? I imagine the other investors as well, could benefit if you're a doctor putting money into this fund. You don't want an attorney and a landscaping guy running the deals. You want someone who's experienced in your fund. You guys are loaning money to folks. You want someone who understands that market, managing that money, I would imagine. So that's a great advantage for those investors as well, to be a little bit more hands-off.
Yeah. 100%. Yep.
Yeah. Are there any disadvantages to a fund compared to other models?
Yeah. I would say disadvantages. It's a little more expensive than a syndication for sure to set up. Typical fund cost to set up is about, I would say 30 grand to 50 grand for a first time fund. Now for my funds, I've set up funds for 12 grand, about 15 grand, because, and the way I pitch lawyers, lawyers bill by the hour. And if you walk into a lawyer's office and you go, hey, I don't know much about funds, can you help me set up a fund? And they'll happily teach you about funds for the next 40 billing hours, right? And they're going to charge you a lot of money. I walk into a lawyer's office, I go, hey, I want XYZ with a drink and a side of fries, and give me my fund. And they go, bam, okay, here it is. And it's 12, maybe 15 grand. And so, and then that cost is reimbursable by the fund as well. So, anyways, you don't want your lawyer to also be your teacher, is what I was trying to say there. And you guys know that lawyers love to talk slow and be methodical. And it's like, hurry up, I'm going to strangle you if you, anyways. As well. But disadvantages, a little more expensive. And then number 2, you're asking investors to trust you in a blind pool. You're asking them, hey, trust me and my team. Over the next 24 months, we're going to go buy 10 properties in this certain asset class. We've got a few lined up, but we want to buy this, right? And in a syndication, they can actually see the property, they can see the deal, they can do a little more due diligence. So there's an extra layer of trust. That's why actually syndications is a great way to start. Build yourself a track record, get investors to know, like, and trust you. And then most of our groups, we transition from syndications to funds for them to be able to scale. So makes sense. Does that make sense?
Absolutely. So as the sponsor, as the manager, the fund manager, right? That's the right term, I believe. as the fund manager, how do you get paid? Is it similar to a syndication? Does that change? Can you set it up however you want? How's that work?
Yeah, great question. The nice thing about funds, by the way, a lot of the questions you have about, I'm so sorry.
You're good.
I got something in my throat. The nice thing about funds is you get to, we say, write the Bible. You get to decide pretty much all the rules, laws, how you're going to run the fund, which is really great. So you can decide how people are paid, how it all runs. Now, I'll give you some examples of typical funds and how they're structured. If you've probably heard of a 2 and 20 model, right? 2% management fee, 20% carry. A lot of funds do that. It's a little more complex than that in a waterfall structure. I'll walk through briefly, but you can also tweak that. So 2% management fee, very common, taken off the top. My funds, though, actually, I charged a 0% management fee because I was young and I still am young. And I go, hey, investors, I'm not going to make any money unless you make 8% first. And that's called the pref. So a lot of funds will still do this, but I said, hey, I'm going to do an 8% pref, meaning first 8% of all returns goes to my investor. If we make a 7% this year, I don't make any money. Now, after that, we do a thing called a catch up to the general partner or the fund manager. For us, we did 2%. So first 8% went to the investor. The 9th and 10th percentile came to me, the fund manager. And then we did 80-20 above then. So 80% to the limited partners and 20% to the fund manager, me. Now, what we did, so that's a typical fund. A lot of funds will do that. That's typically why you hear a 2 and 20, 2% management fee, 20% carried interest. What we did is we said, hey, once we get above a 20% IRR, we then will split 50-50. So it incentivizes me to make higher returns. So if the fund does a 28% this year, yeah, first 8% goes to you, next 2% to me, 80-20 until 20% IRR. And then from 20 to 28, we split 50-50. So I get 4, you get 4. And it incentivizes me to get higher returns. So you can play with those things. I've seen some funds do a 6% pref, different management fees, different prefs. My dad's funds, one of his first funds, this is how they structured it. They literally did a 16% pref. They said the first 16% goes to investors. We don't make any money unless you guys make 16. And then they said, we keep the rest, which is pretty interesting, right? And they were doing hard money loans and they were doing it on an APY. Okay. So, if they had a hard money loan that made them 10% in 1 month, okay, 30 days. Well, the annual yield on that is 120%. So the investors, yeah, you guys get the first 16. We take the next 104, right? And guess what? Investors were happy as ever. They're bragging to their friends, hey, I'm getting a 16 with these guys. It's awesome. They pay me every quarter. And little did they know the fund managers are ripping 100% on it, and both parties were happy. It was a win-win, right? Sure. And so a lot of ways to structure a fund. You can really do whatever you'd like. And those are just a few examples. We can dive into more examples, but it's kind of cool how you can play with those structures to incentivize investors or yourself.
Yeah, that's awesome. I know, and I've listened to some of your videos before and watched them. So there's all different types of companies that and styles of businesses that use funds. So it's kind of neat that you can kind of tailor your fund to that specific investment vehicle. That's really cool.
Yeah,
very, very cool. Yeah, is there any? This is kind of an off the wall question, not necessarily, but are there any tax ramifications of those different structures, or is it pretty much all just pass through since they're LLCs?
No, there is a tax. There is a big tax implication for funds. Fund managers, if you hold an asset over 3 years, I believe it's 3 years now. Trump just moved. It used to be a year. Now it's 3 years inside of a fund. You pay long-term capital gains as a fund manager. So your income from the fund, instead of being taxed at, an ordinary income in the United States, like 40 something % plus state taxes, you're taxed at around 20 to 25%.
Wow.
So it's a huge tax. And then especially if you're doing real estate, you pass on the depreciation gets passed on to the limited partners and the general partner, right? On the deal, and depending on how the structure set up. And so that's the reason Trump and Mitt Romney, political guys, they don't want to disclose tax returns because those guys run funds. Yeah. And their funds are in real estate primarily. And they're paying very little tax. And it's, love it or hate it, at least in the United States, the IRS has incentivized fund managers to start funds. they're pooling capital from overseas and investing in America. And IRS has said, okay, we're going to incentivize fund managers. You guys get a big tax break for running funds. And so we'll see if Biden, they've been talking about potentially changing it, but as of right now, you get, and I believe you have to hold the asset for over 3 years, but you'll be paying long-term capital gains on that as well. And your investors will as well, with passed on depreciation. Depreciation will happen for syndications or funds, but the long-term capital gains is actually a benefit from the fund structure.
Awesome.
Yeah.
Awesome.
Yeah, it's pretty cool.
That's neat. I definitely learned that just now.
I'm not sure in Canada though. I know you got some people in Canada. I don't know about Canada, but that's at least the US funds are that way.
Yeah. That's awesome.
Yeah.
Yeah, a lot of what happens in Canada is modeled after what happens in the US. So thank you so much for so far. Our audience is really interested in real estate, and therefore, Bridger is a fund well suited for real estate. Would you say?
100%. It's like the best. I mean, real estate funds are the best one. I would argue that, and venture capital. Venture capital has great lobbyists. They have pretty much no laws around venture capital. It's amazing. Real estate's a second best, because you have tangible assets. You know, they're not going to go to zero. Yeah, for all the reasons you love real estate: appreciation, depreciation, and you can pool money together. Especially with real estate, the really nice thing with a fund is you get access to bigger deals. Everyone and their grandma can put together a couple $100,000 and go flip a house. And so hence I at least in the United States, in the areas I've seen, I mean, there's so many bidders on, properties under $1 million right now. It's just insane. But once you hit a $10 million, 20, 35, $50 million property, the bidders go like this, right? Instead of having 50 bidders, you have 2 bidders. And the economies of scale in a real estate fund, it allows you to get access to deals that others could not close or transact on, which by definition, usually if there's less, if you look at economics, supply and demand, right? If there's less bidders, that you can usually score better deals. Even in a market like right now, you can still score really good deals because the nature of a lot of people get outbid in those types of markets. And it's a great thing for investors, a great thing for fund managers. It's good all around. And it gives you guys as well, when you have a fund, it allows you to go hire people. You can hire management teams and people to go out and check properties and all that kind of stuff. The economies of scale are so beautiful, especially in a real estate fund.
And so you've mentioned loans and flips. Can you give other examples where a fund is well suited to invest?
Yeah, well, I just mentioned real estate. I'll give you a few just unique real estate examples. We have a number of groups right now. Actually, our fund, I'll just tell you about our fund. Our fund's looking to buy big box stores. So Kmart, Shopko's, Toys R Us is out of these big box stores, buy them, repurpose them into light industrial. A lot of the cities want to rezone them. We'll put townhomes in the parking lot. We'll put drive-throughs. I mean, we can do a lot of stuff with these properties because anyways, a lot of meat on the bone for these properties. There's a lot of unique niches inside of real estate that all of you know of, whether it's industrial, whether it's storage facilities, whether it's tiny homes. I've seen a number of funds doing tiny homes. I'm sure you guys have talked about that on this show, but a lot of cool stuff and then all it is essentially a fund. Take any strategy you have in real estate. If it's working well at this level, why not blow it up into a fund level and just do more? That's all a fund is. It's just a catalyst. And you guys know better than me that all the unique niches of real estate right now, there's so many different, seller buybacks and notes and there's just so many things you guys can do on properties, and then repurposing properties, whether it's construction, whether it's big box stores, like I mentioned before. There's just this, and that you have migration patterns happening right now. So buying up certain areas. There's a lot of stuff that can go on, especially when you have a big fund behind you. It just allows you to do so much more.
Mm. And so some members of our group are looking at starting their own fund. Would you have any recommendations for somebody looking to start their own fund?
Yeah, I would say, and this is my just personal experience and people that we worked with in the fund world, it's almost, and this is how I was, you don't know what you don't know. It's kind of a reserved group that runs funds. And most people, they go, I didn't go to Harvard. I didn't work on Wall Street. I can't do the fund. right? It's out of my league. And I understand the uniqueness of my position. I had a dad who did it. And he's a really regular guy. He graduated season B's from college. And most people, if they see their dad do something, they believe they can do it themselves. And so that was born into me like, oh, if he can do it, I could do it. Like, and that right there is the biggest thing stopping most people from starting a fund is they don't even, number one, believe they can do it. And then number two is the education behind it. Like, it's like, I don't know what I don't know. So I was lucky enough to have a great mentor, and I understand the uniqueness of that position. And that's why we started Investment Fund Secrets. So that's why we started our channel. We have courses and we have coaching and stuff we offer now and all that kind of stuff to just, number one, the first step though is educate, understand how the game is played, understand what's going on in the marketplace. You can't make a strategy on rugby if you don't know what the rules of rugby are, right? You got to learn what the rules of rugby are first, and then you can make strategy within it. And so that's first off, we teach that. And then there's a number of things there, raising capital. We have a fund launch formula we walk people through and all that kind of stuff. But that's what I would say. And that's why we started Investment Fund Secrets, to just show like it's possible. Like you guys can do this. It's not for everybody. Running a fund is a big deal, but I believe more people should be thinking about running funds and getting into this space because it's so lucrative. And people that we had some people on the call earlier, right? And sounds like they're doing incredible things. Why not scale through a fund? So you can tell I'm passionate about it, but that's my thoughts.
Awesome.
What would you say was the coolest project you've worked on so far?
Yeah, it's a good question. Number one, in my own funds, and then number two, I work with a lot of funds, right? So I get access to really amazing, cool opportunities a lot, just by the nature of what we do. The first thing I'll say is when you tell people you run a fund, it's like a buzzword. For whatever reason, you go to a dinner party, you talk to people, and you say, hey, yeah, I'm a fund manager. We run private equity funds. We run real estate funds, whatever you do. People won't let you stop talking. They go, wait, I want to hear more. Like, can you tell me more about what you do? I want to, and it's actually, I was surprised how easy it was to attract, really, back to your question, interesting deals and partners and people, because the buzzword of a fund, and I know how funds work and run, and people are attracted to that. Just like this call, right? You guys wanted to bring me on because I know how funds work and talk, right? It's kind of a buzzword. And so back to your question though, kind of most interesting projects and deals because of that. And we get pitched a lot of stuff. So one of them, I don't want to share all the details because it's a really cool project. I don't want to spoil his details, but they were essentially going to rent a spot on Jeff Bezos' rocket in Blue Origin or SpaceX. They were looking at both of them. They were going to go to the moon, be one of the first groups on the moon, and harvest materials from the moon and do some really cool stuff with them. They had this whole strategy of what they're going to do with all these moon rocks and stuff. And anyways, had this whole. Anyway, it was really cool. I won't spill all the beans, but it was I was like, man, they were looking for like 5 million. I was like, I don't know about this one. We have a number of groups though, on a more, I guess a more practical sense, that I think are really impressive right now, going after the green energy space. You see many countries, including the United States and Biden, pushing for infrastructure deals, green energy deals, and really just throwing money at anything that is green energy. And so it's like, why not just get in the way and catch some of that money? And so we've got two groups. One group's they've raised like 25 million. They're looking to raise 50 million. They're partnered with a huge green energy firm out of Southeast Asia. And they do all these crazy, they've already have huge contracts. I mean, it's just crazy. All the contracts they have, they're doing hydrogen. They're producing hydrogen in plants and all this kind of stuff. It's really cool. Another group out of, I believe out of Tennessee, they have the largest hydrogen plant in the world. They turn manure into hydrogen. He already has the plant. It's like $150 million plant. He's looking to raise another $50 million. He's in our Black Card group, our group, and we've helped him out with the money raising part. But really cool to see that, and the amount of government contracts and just money that comes their way is really cool. So that's a space, even myself, I'm looking to get into more, just because the wave, there's usually waves in our lives. We've seen waves, right? And actually, my dad, this is one of his famous quotes. He loves telling me this. He goes, Bridger, when I was young, I used to put my hands up and try to stop the wave, right? I don't want the internet, or I don't want the whatever it was, right? These waves that were coming, and social media is bad for us. You go, stop the wave. The wave's coming. And he goes, as an older man, I said, you know what? I'm going to grab a boogie board and just go with the wave. and I'm going to make money along the wave. Right now, the green energy wave is happening. And then there's like 10 other waves. There's like AI, there's, I mean, self-driving cars, there's all these waves, but green energy is a huge wave happening right now. And, you might as well get a boogie board and go with the wave. And millions of dollars, millionaires and billionaires are made out of the wakes of those types of waves that come. So
you need to make a t-shirt of that. Go with the wave.
I love it.
I love that idea.
Yeah.
Makes a lot of sense. So we've talked a little bit about what you offer, your coaching and your courses. How can people learn by taking your courses?
Where do they go, or what do they learn, or what do you mean?
Yeah, a little bit of both. So
okay. Yeah, well, for people that are listening, we actually just launched a free course, like literally 100% free. We compiled all of our best videos, podcasts, blogs, all this stuff. If you go, our website's called investmentfundsecrets.com. And then I think you just type in free course and, or free, let me double check. We literally launched it today. Let me double check. It's free, free gift. That's what it is. investmentfundsecrets.com/free gift. Literally, it's a whole course. You guys can hop in there, grab all the videos, 100% free. Literally, I think you put in your email, it creates you an account, and you can hop in and check it all out. So investmentfundsecrets.com/free gift. As well, if you want to learn more about what we do, bridgerpennington.com or investmentfundsecrets.com, you can go in there. We have a bunch of videos and stuff like that. We also have a free Facebook group that I go live. Actually, we're just live in a few hours ago. We talk funds every week in there. We try to give out a lot of free content to just help more and more people start funds. And yes, if you want to work with me one-on-one directly, we have that kind of stuff set up as well. But we try to just really, really give, and karma, right? The more you give, the more you receive, and the more we help more people, I think the more it's going to help. Actually, for me, literally selfishly, I want to hear about your funds. I actually maybe want to partner with people. I want to help raise money for funds. And it just brings in more people to our ecosystem. So investmentfundsecrets.com/free gift, go grab that free course and you can start there.
Awesome. Thank you so much, Bridger. So we have a few questions from the audience. One from Jacob, two from Jacob, actually. I would love to have a better understanding of how you went, Bridger, from Fund 1, very small, informal, and structured, to Fund 2 in terms of raising capital.
Yeah, great question. Fund 1, we again $49,000, super small. We raised that from it's like 7 or 8 investors or something like that. Very small check sizes. It gave us proof of concept. And that's what we needed and we were doing a very unique niche. It was really kind of untested. We're doing these small loans to private individuals, unsecured, but they proved very successful. And so our second fund we launched. Now there's 2 different types of fund strategy, open-ended versus close-ended. And a close-ended fund is very traditional for real estate. You'll do a 6 to 10 year fund. You open the fund at the beginning, you raise money for 12 to 18 months, you close it, and then you buy properties over the next 7 to 8, or next 2 to 3 years. You season those properties and you sell them in year 6 or 7. It's a close-ended model, and you'll launch multiple funds. Every 18 months, you're launching a new fund is there. We launched an open-ended model. A lot of hedge funds will use this. We were running a debt fund. An open-ended model, the way we ran it was investors could come in, their money was locked up for 1 year. But after a year, they could just give me a 60-day notice and they can move their money in and out as much as they want. So in hedge funds, you see that because investors will come in and out of a hedge fund. Real estate, though, it doesn't work that way. If you have 5 properties, you can't liquidate investors very easily. That's why it's a closed-ended model. So we were running an open-ended model. Fund 2, we launched, I believe the first month, we raised just about $180,000. So a little bit bigger. And I was testing out because these loans were like 5 to 10, 1 to 10 grand, maybe in that range. And the loans were lasting only 3 weeks or 4 weeks. They're very fast turning. So we would have $100,000 every month that would recircle, right? And so it's kind of like, how much money do we need? And so we started with 150 grand, then we inched up to 200 grand, then we went to 250, and then we went to 400. And the nice thing about that fund, every single quarter, and then we turned it to month, I was taking all the returns from the month and paying out investors. And what happens is investors love to brag about their investments. And so we had initially like a handful of investors, and they all, at the country club were bragging to their friends, man, I'm investing with this kid named Bridger. He's doing really well. We're getting checks every month. It's awesome. I'm making like 2, 3, 4% a month. This is great. And they, oh, what's his name? And they'd get my number and they'd call me. And then I'd say, well, yeah, we'll take another 50 grand or 100 grand. We slowly grew this thing and it got bigger and bigger. We were rolling about $1 million a month. And then we started to turn away investors because we were hitting because that's a lot of loans. That's a lot of $1,000 loans, right? Every month. And so, and we were kind of tapping out our market. We were doing pretty much all of the loans in our market. We did almost, I think 80-90% of the loans came through us. And so then we were sending money back. And then what I was doing was I was sending money back and I was putting my own money in, more of my own money, and sending money back from investors because I'm selfish. I want my own money in there. And so anyways, that's what we did. And then finally we had a competitor come by. We had kind of beat him in the market. He wanted to buy us. And so I said, okay, you got to pay for it. And so he bought us out. And I wanted to move on to a bigger fund just because we had a lot of investors lined up. And so that's how I kind of built my track record of investing with investors. And now I go, hey, we're launching a new fund. We're buying big box stores. Who wants in? And we very quickly raised over 10 million. And then we've moved that to 16 million and we're continuing to move that as well. And so anyways, it's been an interesting game, but that's kind of the long and short of it. You got to start somewhere and then making sure those early investors are getting really good returns. And I try to take care of them as best as I could. And they'll brag and tell more people about it. And that's kind of how it grew. Good question.
Thanks. Logan, you're muted.
Mute. There we go. Sorry. You guys are tired of hearing from me. Sorry. So another question coming in is, on the outbidding front, does this create sell side risk because the same dynamic occurs for buyers?
It's a good question. On the other, and I'm guessing they're talking about big properties, correct?
I believe so.
Yep. So that's got to go into your thesis, right? Of your investment thesis on real estate. Now, the groups I've worked with, and I'll share my dad's group. I actually, I've worked with a number of their properties and things like that. They buy their main thesis in their multifamily fund. They're buying C and D class apartments and they're upgrading them to B or hope maybe even A class apartments. So value add fund. They have a clear exit strategy when they enter these properties. They actually, they've already identified a number of big groups, REITs, other things like that. They're not hands-on. So a lot of groups, there's a lot of investment firms, real estate investment firms specifically, that are not hands-on. They want to buy cash flow properties. Like Grant Cardone's a great example, right? Like he's buying the worst cap rates you've ever seen. Like, you know what I mean? And he's kind of an outlier, but there's some funds like that. They don't, I don't know. They're trying to deploy capital, right? They've got this huge endowment. They've got a big REIT. It's kind of over bloated. They can only upgrade properties a little bit and they just are stuck. An investment fund can come in and say, hey, we're buying, a C class apartment. We're going to upgrade it to a B plus, maybe an A class apartment complex. We have 200 units. We're going to renovate 150 of them. We're going to leave 50 of them, a little bit of meat on the bone for the exit strategy. And then we'll give them the plans. Hey, when you buy this property, you can renovate the last 50 units and it's going to give you a little bit of meat on the bone so that you can sell it for more in the future. And also we have a 95% occupancy on the property right now. It's doing very, very well. This is a cash flow property and we sell it. And that's traditionally their strategy. So the exit strategy is a very important process. You got to build something or create a product that other funds or other endowments or other whoever will want to buy. As you guys know, there's a lot of lazy real estate investors out there. And that's one strategy, is just outworking. And it's the same thing on house flips. It's the same thing, the house flips, and it's the same thing on 300 unit apartment complexes. Same thing. A lot of people don't like to buy a rundown house. A lot of people don't like to buy a rundown apartment complex. Mm-hmm. Let's just buy those. We'll upgrade them and we'll sell them to people that want the done for you real estate project.
Yep.
That's awesome. A really good question. I don't know if does that answer the question, or are there follow-up questions?
Yeah. I think it definitely answered it.
A question from Darren. Has anyone scaled too large?
100%. Oh yeah. The Jim Simons is a great example. One of the greatest investors of all time. You probably haven't really heard of him. He runs the Medallion Fund. I'll actually even Google it right now. He has not taken new investors in over 15 years. To invest with him, you have to have a minimum $100 million check to invest with Jim Simons and hasn't taken money in over 12 or 15 years. It's insane. I'm going to look up their AUM. I believe, okay, they manage $165 billion.
Wow.
Somewhere around there reportedly. Okay. He actually mentioned their hedge fund, their strategies only work in some of their funds. Their medallion fund is their top fund. And by the way, he charges 5% management fee and 45% carry. Most funds are 2 and 20. He's 5 and 45. And he hasn't taken a new investor in 15 years because he has too much money. Minimum check size, $100 million. That's a pretty good position to be in. He's one of the wealthiest people on the planet. But he said in their medallion fund, they became too large that they were moving markets, and that it actually ruined their algorithms. They took on too much capital and it ruined their algorithms. So as far as becoming too large, that can happen where you're moving markets. You got to be able to deploy the capital. Now, depending on what you're doing, that'll depend on being able to deploy capital into your niche. We became a little bit in our even at our lending fund, we became a little too large. We couldn't deploy the capital fast enough. We didn't have enough loans. So there's always that. Fund managers are always playing that game of, can we deploy capital into this market? If actually you Google right now, the term is dry powder. You can see right now we've hit record high dry powder. So dry powder is investment funds that have capital commitments for investors, but have not called that capital yet. They're just waiting to deploy it. I'm going to look it up right now. I'm live on Google. Here we go. Dry powder amounts. I believe in 2020 and 2021 were the highest they've ever been. It was something like let's see. Okay. This is of April 7th. They report $976 billion in dry powder just from private equity.
Wow.
So
just sitting there. Yeah.
And then you see these really big acquisitions. That's why, right?
Mm-hmm.
The price PE ratios that are way drawn up. It's because there's these big funds that have, it's either they deploy the capital or they lose the capital. They got to send it back to investors. So they're like, well, we'll pay a little bit more on an EBITDA, we'll pay 28x earnings or 30x earnings or 40x earnings, right? Because we have to deploy capital. You see the same thing with SPACs. SPACs right now, a lot of SPACs are looking to expire in the next 6 months. They've raised $180 million. They're trying to deploy it into a company. They can't find a company. And if they can't deploy it within 6 months, they just have to send the money back. And so they're like, well, it's better to buy something than send the money back. And so they're bidding up the market right now. It's a very interesting game. So yes, to answer your question, you can get too big, but usually, real estate and stuff, you got to be smart, look at your things, but there's usually properties to buy until you get over, $5-10 billion.
Yeah. Oh, that's awesome.
Yeah.
That's awesome. So one question comes in about loans, and what is the process of getting a loan inside of a fund? Obviously, these aren't all cash deals. What's the process of getting a fund for the loan, getting a loan for the fund? Is there a guarantee? How's that work?
And just to clarify, like your fund is going to buy real estate
Sure.
to get a line of credit or a lender, a bank to lend on that property, correct?
Yes.
Yeah. Great question. On your first fund, primarily, you're going to say, and I've actually seen this in a number of funds, if you're under $25 to $30 million, they are still going to require a personal guarantee on that loan, which sucks for the fund manager. I mean, it really does. It's like, hey, we got 25 million. You still need a personal guarantee. And they go, yep, we need a personal guarantee. Usually after your first couple of deals, then that goes away. You don't need a personal guarantee anymore. The bank will lend on the assets of the fund and backed by the fund. So essentially you have a $50 million real estate fund. You're going to borrow, $25 million for various projects. That 25 million is in first position. That's paid out first. Even if properties go down, whatever, that is first position paid out. Second is your investors in your fund. So, but the first couple of properties, the funds I've worked with, typically it is still a personal guarantee, which anyways, nature of the game, you'll move out of that though pretty quickly once you transact a few deals.
Sure. So the loan would be in the GP, in the name of the GP, not in the name of obviously in the LP.
No, it would be in the name of the LP.
Okay.
It would be to the limited partnership, but backed by the literal owners of the general partnership.
Okay.
Not even the entity. They want personal guarantees from the owners of the general partnership. I've seen a number of funds. They've tried to work around it, and some have. Some lenders right now are rich. Key Bank is a good lender right now. I've seen, there's a few other lenders that, sometimes will give you leeway, but I've seen a number of them still have to personal guarantee it.
Okay.
Yeah. That's a good question.
How do you know when you have a good idea that's good for a fund?
You've tested it. You've done it at a small scale, right? Like everyone on this call, if you've done, we had guys doing light industrial, or someone that was doing, or wasn't it Darren doing industrial, and I forgot the other guy doing medical supply things. Anyways,
yeah,
you can kind of test your thesis out at a small level. Now there's some things you can't test out, you can kind of do theories and hypothesis on, but you can't really test out. A good one way to do it is you do a large syndication. So you could do, hey, we want to move into office buildings. We're going to take down a $25 million office building. We're going to syndicate money on it to test our thesis out, right? And hopefully you've brought on a good team, though, of people that have worked on similar deals or similar things and can consult. Maybe you haven't done one all yourself together, but you've got a pretty decent team. You feel confident what you're doing. Again, you're never going to have 100% guarantee, but you're confident enough like this is going to work. We've seen other deals just do the similar thing, and that's what you're going to do. So you can do a large syndication, or you could just move right to a fund with this specific thesis. It's just like doing your first house flip, right? Mm-hmm. You've seen other people do it. You know the process, but you're like, should we do it? It's the same thing. It's a $250,000 property or a $250 million property, right? It's just scale, and it gives you the same heartache though, whether it's whatever deal size you're at.
Yeah. I think that kind of answers a little bit of the next question, which was what's the minimum deal size on a property that typically works for a fund? And then the follow-up to that was, is there a minimum return for investors? So kind of trying to get to the smaller side. What is that minimum for property size and fund size?
There really isn't a minimum. I mentioned that earlier. Guy in our group, 75 houses he's flipping. He only flips houses like that are 100 to 200 grand, something like that. Maybe 300 grand. So very small, but pretty much as small as you can get on real estate. So yeah, you can do it there. And you can go as large as you like. Again, you get to write the rules of a fund. It's the best part. You get to write the Bible. You get to write the covenants and laws of what you're going to do, which is fantastic. Minimum return for investors. Again, you decide that. There's some funds that I know that they go out and they pitch investors, hey, we're going to try our best to get you a 7% return this year. And we're going to do all these things, and investors invest in it. And because it's not just return, it's also risk. What's my risk adjusted rate of return? And so, I see though a lot of back to probably the actual question though of what do I see? Most funds I see in real estate are, looking at anywhere from a 12% return, usually up to maybe a 20 to 24% return, with probably an average of about a 16. So telling investors, hey, we're looking to get you a 16. We're going to do X, Y, and Z. That's what we're going to do. I've seen some funds, hey, we're going to do a 12. It's a lot safer investment. Not as much upside, but not as much downside, right? So risk adjusted rate of return again. So you can see all the above. Now, there's a big difference though, between what you pitch your investors on and what you're actually going for. One of the biggest things, every fund manager I talk to, they always mention managing investors' expectations is one of the biggest games of a fund. If you promise an investor a 30% return, and you get them a 25, oh, you're an idiot. You can't do anything. You're the worst fund manager ever. But if you promise them a 19 and you get them a 25, you're the best guy ever. Man, this guy's amazing. He's outperforming everything. It's blah, 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 all these great things. So it's all about in managing investors' returns. So a lot of funds I see, they pitch a 16, 17 return, IRR, whatever you want to do. Their actual internal target is like 24, 25, 26. That's what they're actually going for. Like, hey, we're going to go for 24. Yeah, we're telling investors 16, but we're going for 24, 25, 26. But because we want to under promise, over deliver. So anyways, something to add there. And then also on pitching returns, sorry, I'm rambling on, but another group we were talking the other day, a crypto fund, really cool guys are putting together a crypto fund. They're like, yeah, we really think we're going to get investors like a 35, 40% return this year. And I'm like, okay, what's your risk on that? Right. Let's look at the downside. And then I said, number two, I go, when you pitch investors a 30 or a 40% return, right? Really high, you attract very risky investors. You attract the Dogecoin investors. You attract the really risky investors. It actually will scare away some, more traditional investors, because they'll go, that's just too outlandish for me. I even if you're going to do it anyways, don't pitch them on that, because they'll go, no, it must be illegal. It must be drugs. It must be something, right? They're used to a 12 or an 18 or a 17. Even if you're planning on getting a 40, there's actually a ratio. When you pitch higher returns, it doesn't mean you're going to raise more capital. It actually gives a diminishing amount, I believe, the higher you pitch. And so it really comes down to investor returns. And usually as you get bigger with family offices, with institutions, they understand investing on a broad level. And if you pitch them at 25, they'll kind of laugh you out of the office. They're like, okay, get out of here, kid, So anyways, long answer, but anyways, hopefully that helps. A few thoughts there.
Yeah. I kind of have one. I don't see any other questions. I want to throw one in here just at the end. So when it comes to actually raising the fund, so you want to do a fund, your thesis, you got everything, and you want to actually go after investors. I know there are some definite no-nos that are out there. Can you walk through a little bit of that and how you can go about finding investors without having the SEC breathing down your neck?
Yeah, it's a good question. Okay, there's a few different ways to file. Number one, so you got to decide how you want to file. I wish I could. Well, I can share my whiteboard if you want, but a lot of funds, in the United States, a Reg D 506B fund, you cannot publicly advertise, and investors they self-verify, which is great. They just check a box that they're a credit investor or above. Great. You cannot advertise though. You can now. There's a few other options where you can advertise. Reg D 506C, C as in cat. So the other one was B as in boy, C as in cat. C, you can advertise. However, investors have to self-verify. So they have to, you can use like verifyinvestor.com or other places to verify your investor status. There's also ones like Regulation CF, that's crowdfunding, and then Regulation A or A+. Those ones you can also publicly advertise on. So anyways, pick the right filing for you. Now, whether you're going to advertise or just do kind of word of mouth, like most funds are in more of introduction based, word of mouth based. The rule is you can't publicly solicit. So you can't be running ads or a billboard or something. But if you meet somebody and you already have a first meet with them, you can then later on talk about your fund and invite them into your fund. It's a private offering. And so anyways, for both, and I don't want to go, we can go deeper if you want, but in general, fundraising and money raising, there's a couple different tiers. Number one, getting in front of the high net worth individuals. That's the first step. How do you get in the same room with them? How do you get in the same area or the same place online with them? Okay, that's the first step. And then second step, how do you translate them from just a friend or something you met at a party to someone that's actually interested in investing in your company, right? And in your fund. And then finally, how do you take someone who's interested and actually close them on a pitch or a call or whatever you're going to do? So there's kind of three tiers. Number one, just getting in the room. Number two, converting that person from a friend to a potential investor. And then three, actually closing that investor, getting them to sign the subscription documents, all that kind of stuff. And so we can talk more about, whether each section or how I have strategies for each one of those and how I've gone out and done things. I'll just say in general though, fund managers are great marketers, and most people overlook that. Fund managers are fantastic marketers. Whenever you're doing that waterfall structure I just talked about, that's marketing. That's all that is marketing. Hey, we're going to give you 8% first, and then we're going to get the next 2. That's just to incentivize investors. That's marketing. The process of when investors come in, when they can come out, a lot of it's built around how do you incentivize investors to come in, they feel safe, they're going to get a great return, and then move on. How do we market to investors? And so really the way you structure your fund is a whole thesis around marketing to investors. What are things that investors will like to get into? And so the way you structure your fund is that way. The way you get in front of investors and talk to investors and get them to know, like, and trust you in a very, traditional way. A lot of the people, in money raising, I've had a few guys on my show. We always talk about this, but the more you beg for money, the more people don't want to give it to you. It's like chasing the hot girl in school, right? The more you ask, the more they don't want to talk to you, right? Or go on a date with you. And so there's this whole art of kind of playing that game and asking for money, but you don't need the money, kind of a thing, and how to convert that investor on a pitch call. But the last thing I'll say, fund managers are great event throwers. And you'll see this in big funds. They do it privately for big funds because they can't public advertise, but you see it for small funds as well. A great strategy I have used to raise capital. I throw supercar events in Utah. I live in Salt Lake City, Utah, by the way, of all places. Salt Lake City. If I can do a fun in Salt Lake City, you guys can do it in anywhere you're at in the freaking world. But guess what? People with supercars, guess what? They like to show off their cars, number one. And they usually like to meet people with other supercars. So I went and bought an Audi R8 because I like cars too, but I bought a car and I started to network with these people. And I said, hey, let's throw a supercar event. You guys can come over to this big mansion house. We're going to have a food truck there with tacos, and we're going to talk crypto and real estate. And just for a half hour, we're only inviting people that have a supercar. So they know that high quality people are coming. They can see other cool cars. We had about 50 or 60 people show up with amazing cars and all this kind of stuff. Really cool. We're throwing another one next month. And guess what? All those people, whenever you throw an event, I like events. Anyways, one strategy is events. Anytime you go to an event, guess what you remember? The person who threw the event. Mm-hmm. You always remember, right? Oh, I went to so-and-so's house for a party this weekend, or I went to this person's event or party, right? You always remember the person throwing the party, even if it's not at their house, right? So if I can be the event thrower, people are going to start to remember Bridger Pennington's name. Oh, he's the guy that throws that cool supercar event. And I think I remember he runs funds as well, right? And over time, over the next year, 6 months, 18 months, 24 months, I'm going to develop a relationship with these people. And the fund world is a long-term game. The raising capital, this is a long-term game. This is not a get rich quick game. And so play the long-term game, play the game, right? This is a long process. Don't come in and burn relationships and try to move quickly. Anyways, that's just, sorry, a lot in there. We can talk more about if you want, but that's just a few things that have helped me.
That's great. That's fantastic. I think everybody here on this call and everybody's going to listen to this is, they're real estate investors. So I think everybody here tends to have a long-term mindset when it comes to investments. So I think that's right up everybody's alley. Yep. So we've talked a little bit about, we've got one more question here, and it's a little bit more tactical. We've talked about getting started. We've talked about, raising funds, your thesis and everything. This one's about more ongoing. Jacob asks, what are the approximate annual minimum costs for things like accounting and auditing? And does that impact, the minimum viability of a fund size? Should you be shooting for a certain size because of this annual ongoing maintenance costs?
Yeah, it's a good question. It depends on who you talk to. They'll give you different answers. I'll give you my answer. I ran a fund that was $49,000. Okay. Mm-hmm. As a minimum fund size, we ran it just fine. And it was great. Now, we did not use a third-party auditor on that particular fund because it was too expensive, right? There's things that we left out because it was too expensive. I talked to a fund manager. He said, it's really not even worth it unless you have at least 75 million because of the legal, the auditing, the accounting. And I kind of agree with him, but I kind of don't as well because, and maybe he's unaware, there's a lot of new products right now to help emerging fund managers. So a great group we've just partnered with, they're coming in. They're going to actually they're going to help out our students in our program. They do third-party admin stuff, meaning it's a third-party administrator that comes and just checks all your books. They send out quarterly statements. Some investors require it. They will do it pretty much at any size. They'll scale with you. So if you're less than $1 million, they'll charge like $500 a month. So $6,000 a year, they'll do all of that. It's pretty reasonable price. A third-party audit and accounting, you're looking at the low end, $3,000 to $10,000 a year, maybe. You can go even lower. Real estate funds are even easier to do all that for. So you can go, it's relatively, not that crazy amount. Now, if you're only managing $100,000 or $200,000 or $300,000, that can be taxing, right? That's a big proportion of your fund. So maybe like my fund, I'm like, hey, we're not doing a third-party admin. We're just too small at that first fund. Now our new funds, we're doing them because we have economies of scale. And then but you got third-party admins that'll come in, they'll check and kind of audit your fund. They'll manage investor relations. They just make sure you're not a Ponzi scheme, essentially. Since Bernie Madoff, that's kind of their goal. Next is a third-party auditor. They'll come in and audit your books. Again, since Bernie Madoff, pretty much every fund, it's kind of required to have a third-party audit on your books. Low end, $5,000, $6,000, $7,000 for a third-party audit. High end, you can pay $100,000, whatever you want for an audit from Deloitte or whatever company. You got that. And then ongoing accounting, you can use, you want to use an accountant that knows funds. But again, it can be as low as a couple grand a year, depending on how big your fund is. So and then they'll scale up with you, right? As big as your fund is and as much as you need. So There's a lot of emerging things for emerging managers. So all in all, you're looking at maybe, if you did all those, maybe 10 to 15 grand a year of fixed costs in your fund. Now those you can decide, those can be paid out of your management fee, or they can be paid just from the fund. The fund covers those expenses as a fund. So it's not coming out of your pocket. It's coming either out of a management fee, or it's coming out of just a fund expense on there. And then as you scale, third-party admins, they can, once you're big, you're running $1 billion fund, they might be 30, 50 grand a year. You can, anyways, those all can scale up, but there's also very small options for emerging managers that are really great. We actually have lastly, I would say a bunch of softwares we partner with. They're like $50 a month. They do all of your back-end investor data. They'll manage capital calls, distributions, DocuSign, everything's in there for like $50 a month. It's awesome. So There's a lot of small emerging managers. That's kind of what we specialize in as well. We've found a lot of these tools and brought them together for you.
Mm-hmm. Yeah.
Awesome.
Yeah. So if you don't mind, we'll ask one more question. I know we've had you for about an hour and 12 minutes here, so we want to be respectful of your time.
Yeah.
So the final question is, who are the key players in the fund and the key hires you need to make?
Great question. In a startup fund, I'll talk about partners first and then key hires from there. But the way I look at funds, there's 3 distinct players in a fund. You have I'll use my hands because I got nothing better. Over here on my left hand, you have your chief investment officer. This is your I call them your expert investor. This is the guy that's really good at real estate, or really great at crypto, or really great at whatever. Okay. They're usually anyways, well, I'll talk about them in a second. The next group is I call the fund manager circle. This group is a compliance, audit, accounting, all that kind of stuff I just mentioned, all goes in that fund manager. And then finally, you have your money raising partner. Okay. Now, and they're responsible for bringing the capital in. So you got, again, expert investor, fund manager, money raiser. Now you can do all 3 of those roles if you'd like. I did in the beginning. I did all 3. You can do 2 of the 3. You can do 1 of the 3. Eventually, you're going to be doing a slice of 1 of the 3. But don't think you need to do this alone. Okay. So many people don't start a fund because they don't know how to raise capital, right? They're like guys on the show, I've done great in real estate, whatever, but man, I have no clue how I'd raise $50 million. I was on the phone a few months ago. The guy, he calls me up. He goes, Bridger, I've got 2 billionaires that just love me. They think I'm great. They want to invest in my projects and deals. But before I've kind of just brokered stuff, I actually want to be included on a fund. Is that something we could work together with? And I'm like, you got a couple billionaire? I was like, yeah. I'm like, yeah, we can work with that, and he's natural born salesman, really likable guy, just as a natural money raiser, just is. And he's already developed his network for the past 10 years. Okay. Yeah. You can work with us. Right. Other guys, and I call them broke geniuses, the expert investor. They're not broke. They make a couple $100,000 a year flipping houses or trading crypto or whatever they do, but they have no clue on how to set up a fund or raise capital. So what we do is we bring the pieces together and scale up from there. Our new fund, I am not a real estate investor. I don't profess to be. I would say I'm an average real estate investor, maybe a little bit above average, but I'm no way, shape, or form an expert. Although I'm very good at setting up funds. I'm a very good fund manager circle, and actually I'm decently good at money raising. So I went and found a really good real estate guy. He's done all these properties and deals and stuff, and he always partners with great people. And he's never started his own fund or done his own things. And I said, hey, you want to partner up? And he said, yeah, let's do it. Great person to bring on. So I would think about those 3 circles. It's way faster. It's not the how, it's the who. Don't think, how do I learn all about the funds? Find who can I find that can teach me about funds, or who can I find that can raise capital for me, or who can I find that can do the real estate for me, or do the crypto for me, or do the hedge fund for me, and bring those pieces together. And no one does this alone. So my dad's funds, my dad does not know anything about real estate. I ask him real estate questions all the time. Dad, you manage $26 billion of real estate. You can't tell me if this is, and he's like, no. He goes, I have partners who can tell you if that's good, but he goes, that's not my job. I do compliance, legal, audit, all the fund management things. I help raise money. I don't know the first thing about real estate. And I'm like, wow, that's pretty cool, right?
That's awesome.
You don't need to know everything. So that's what I would say.
Yeah. Fantastic.
Very inspiring, and an interview certainly filled with content. Thank you so much, Bridger. Can you just maybe mention again your coaching program for people who might be interested in starting their own fund with your assistance?
Yeah, investmentfundsecrets.com is our channel, or just bridgerpennington.com. They both go to the same spot. And then if you want that free course again, investmentfundsecrets.com/free gift. So that's where you can go. That I think it launches tomorrow, which should be fun. We have a lot of people coming in. And anyways, if you want to check out a free course as well, that's all the stuff. But anyways, and if you want to talk to me, Instagram is a great way to find me. Bridger_Pennington. Shoot me a DM on there. I try to respond to most of those DMs on Instagram, and then YouTube, we put out a lot of content as well on there. So anyways, that's kind of our spot.
Okay. Well, thank you for what you do. It's really inspiring.
Awesome, man.
Thank you guys so much. It's been fun to be on.
Yeah, this was awesome. Thank you.
Yeah, now we have our where we kind of bring into groups and chat together. So feel free to stay if you so wish. Otherwise, we are very appreciative of your time. Thank you for being with us.
Thank you guys. I think I'm gonna hop off. I got it. My wife's waiting for me, so I'm gonna. But
You're
thank
good,
you guys. Let me know if anyone needs any more help or anything, and you can come to our site or message me on Instagram. It'd be a great way to find me. So
I'm gonna check out your site tonight. I'm definitely gonna check out the free gift and start looking into that. So
cool.
Yeah, me too.
We'll be in touch.
Thank you guys.
So awesome, man. Thank you.